This video is for all those new investors who want to get started investing but don't really know anything about the stock market, or may even be scared of the stock market and are afraid to put their money into it and possibly lose their money. I'm going to show you how you should get started, what you should invest in, and get you going. Welcome back, Freedom Savers. So today I'm going to do something a little different. I want to help out the new investors. I've talked to a lot of people in person nowadays about investing, and I'm finding that a lot of people just really don't know where to get started. They don't understand. They might know what a stock is, some don't, but they might not understand investing for long term. They just know they need to invest, but they don't understand the stock market at all, and they're scared. I mean, obviously it's a risky, when you invest, the stocks can go up and down and it gets very scary. The thing to keep in mind is, over all of the history of the stock market, it has always recovered from any downturn, and gone farther into the profits. So it's always made a profit. Now, of course, past performance does not indicate future performance, but it's all we have to go on. And there have been many people who have made millions of dollars in the stock market. And if you're new and you're starting out and you just need to invest for your future, you need to be in stocks. If you're not already got a business that's making you, 6 figures plus every year, you got side hustles making you tons of money. If you're not rich, basically, and you work a normal job and you're trying to invest for your future, and you're young, you really need to get in the market. You need to start investing now and contribute monthly. The way to get rich is to continually put part of your paycheck into investments every single month. Make your money work for you. So today I'm just going to go over how to get started in investing, some very basics of how the stock market works, and what I would suggest if I was in my 20s or 30s and just getting started investing. So to start out, I want to make sure that you guys know what a stock is. Obviously, a stock of a corporation is all of the shares into which ownership of the corporation is divided. So basically what this means is, when you buy a share of stock, say that you buy 1 share of Apple. Well, you are now an owner of Apple. You own that business. You own 1 part of that business. Now, they put out however many shares, say they have 1 million shares out there. Then you own 1/1,000,000th of that company. But you own it. And you need to understand, when you purchase a stock, you're not just buying a piece of paper. You're not just buying something that's speculative and may go up or down and blah, blah, blah. You're buying partial ownership of a business. That's what you're buying when you buy a stock. So you need to keep that in mind. And that's also why it's so important to understand what a good business is and what a bad business is before you purchase stocks, because you're actually buying a business. Now, for those getting started, I don't really suggest individual stocks. You'll look at my portfolios and I have a ton of individual stocks, and the majority of my portfolios are all individual stocks. I only own 1 ETF right now. And I think individual stocks are great investments, but you need to know a little bit more about what you're doing. And this video is for those just getting started in investing who want to invest for their future, but don't necessarily want to know everything there is to know about the stock market. So now that we know what an ETF is, or a stock is, let's look at what an ETF is. So an ETF is an exchange-traded fund that's traded on stock exchanges, much like stocks. An ETF holds assets such as stocks, commodities, or bonds, and generally operates with an arbitrage mechanism designed to keep it trading close to its net asset value, although deviations can occur. So to break that down into plain English, basically what an ETF is, it's traded just like a stock of a company, but it's not a company that you're purchasing. You're purchasing a share of ownership in that fund. And it could be a fund that and that tries to follow the S&P 500, or it could try to follow the Dow or the NASDAQ, or it could just try to follow the gold market, or it could just have its own collection of stocks, like a growth fund. So it just invests in growth companies or companies it believes will grow. Or it could be a value fund where it only purchases when they're at a discount. Or it could be a dividend fund where it only invests in dividend paying companies. There's all kinds of funds out there and all kinds of things, but you don't need to know them all. All right. All you really need to do as a new investor is follow the market. So follow the major indexes. So a fund. So let's look at a fund. A fund is a collection of stocks, bonds, commodities, etc. We aren't going to get into all that, commodities and bonds and all that, but basically we'll say that it buys treasury bonds from the government. All right, a bond is just a loan. You give the government a loan and they give you a piece of paper called a bond, and it promises that they will pay you interest on that loan. And that is where you get your money from in the bond. So there's treasury bonds, there's corporation bonds, there's all kinds of stuff. A bond is a loan, basically, and you're giving that loan out when you buy a bond. And then you're going to earn interest on that loan. That's all a bond is. So anyway, in a fund, they could have a collection of a bunch of bonds, treasury, corporation bonds, international bonds, etc. They could have whatever they want. They could also have a bunch of stocks. So they could own Apple and Microsoft and Google and Amazon and a bunch of littler ones even. WDR. Anyway, so we have this collection of investments. All these investments are inside this fund. Now, instead of buying a share of each of these companies, what you're doing is you're buying a share of this fund. And when you buy one, say that these are all that it owns, even though they really own a lot more. In most funds, there's 100, 200, 500. There's a lot of different companies and investments inside one single fund. So that's why it's good, because it gives you tons of diversification inside one share of the fund that you buy. So you buy one share and you have all this diversification. So if one sector goes down, say industrials go down and financials go up, then it balances out and you don't lose money, don't lose a lot of money, and you may even gain money. So that's diversification, is owning a bunch of different stocks and investments together. Well, when you're first starting out, you probably don't have a lot of money to invest right off the bat. So these funds are the best way to do it. And you can buy one share and have all that diversification. So let's say these are the only ones that are in this one, just for example's sake. So that's 1, 2, 3, 4, 5, 6, 7, 8. That's 8 different investments that you get for buying one share of this fund. So when you buy one share of this fund, you get an ownership stake in all of these companies and bonds that this fund owns. So as these go up in value, or pay dividends out, or pay interest out on the bonds, all that good stuff, your value of the fund goes up. And if these pay dividends and all that, they normally pay out that dividend to you in cash in your brokerage account. Funds are great when you're first starting out, because you don't have to research companies. You don't have to know which companies are good or bad. You don't have to know which ones are good long-term investments or short-term investments. You don't need to know all the details, because they're very diversified across all sectors, across a lot of stuff. And you can pick funds for whatever you want. Now, there are different kinds of funds. There are mutual funds, there are index funds, and there are ETFs. And I'm sure there's many more funds, but these are the 3 I'm going to go over real fast. So a mutual fund is one where it has a manager. All right, so it's one guy making the decisions, basically. This guy decides when to buy certain stocks, which stocks to buy, when to sell those stocks, all that good stuff. The other thing with a mutual fund is you only buy at the value of the assets inside it. And it only trades once a day. The other thing about mutual funds is that the fund pays you out. So when you go to sell a share of your fund, that mutual fund itself will sell off parts of all these bonds and stocks inside of it and pay you the money. All right. It's not like you're taking this and trading it with someone else. And as I was saying here, a mutual fund's price is calculated based on its net asset value. So it takes the value of all these corporations in there, and that's how it comes up with the overall value of the fund itself, or the price of the stock that you're buying, the share that you're buying. It's all based on the value of all the stuff inside of it. It's not based on market price. Like, people think it will go up, so they buy it. They think it'll go down, so they buy it, etc., etc. So it's not based on investors' thoughts. It's just based on the value of the assets inside of it. All right, so then we look at index funds. Now, index funds have no manager. So basically, they're a collection. They just take this collection of stocks and bonds, whatever the fund is going for, and put it into a fund. And they don't sit there and buy and sell and try to trade and try to beat the market and all that like a manager does. They just try to match whatever value these perform at. And that's a good thing because there are less fees here. I forgot to mention, mutual funds, higher fees. So you have to pay that manager, you have to pay that company that's sitting here buying and selling and making those decisions, so you have higher fees on the mutual fund. On the index fund, you have less fees. There are still fees because they still have to manage it. They still have to, you know, if a stock changes or splits off or whatever, they have to handle all that, right? So they have to do that, but there's less fees, they're smaller. So an index fund is exactly like a mutual fund. It's basically a mutual fund. That's what an index fund is, except there are no manager. They're not paying high fees to this manager who supposedly can beat the market and buys and sells and makes all those decisions. Instead, they try to just follow that index. So an index, I haven't gone over what an index is. So an index is like the S&P 500. If we go to Yahoo Finance, at the very top here, you'll see the S&P 500, the Dow 30, the NASDAQ, and the Russell 2000. These are the four top major, basically these three are the biggest known indexes. What these are is a collection of those companies, Apple, Microsoft, Amazon, etc., all in one index. And it just tracks the value of that. So it's not a fund, right? Because nobody's investing in these directly. These are just for tracking purposes to track how the market is doing, hence the index. So like today, the S&P 500 closed 0.53% down from yesterday or from Friday. So this is just for tracking how the market's doing. Is the market on a bear run, which is going down, or is it on a bull run going up? And how did it do each day? So that's an index, okay? So an index fund is just trying to follow that index or a different index, all right? So like the S&P 500 index fund would include all the stocks from the S&P 500, all right? So if the S&P 500 index fund, what it'll do is it'll buy all the same stocks that are included in the S&P 500. So the S&P 500 is tracking a certain list of companies, and therefore this index will buy that certain list of companies in order to get the same performance as the S&P 500. Therefore, it is an index fund. It's trying to follow the S&P 500 index. Now, again, with all these index funds, they can index a lot of things. They can index emerging markets. They can index all kinds of stuff that you may never even heard of. But that's how an index fund works. Other than that, an index fund is exactly just like a mutual fund. Now, the difference with an ETF, and I highly suggest ETFs, is one, the value of the shares are based on market sentiment. So basically, it trades like a stock of a company. So say I own 1 share of Microsoft, okay? And Microsoft puts out earnings, and so every quarter the companies have to say what their earnings were, okay? If they're a publicly traded company. So all these analysts are out there trying to figure out how much they're going to earn in the next quarter. Well, all the analysts say Microsoft is going to earn 23 cents per share. So for the hundreds of thousands of shares out there, if you divide their profit up, it comes to 23 cents for each one of those. Okay? That's what the analysts predict that Microsoft will do 3 months down the road. Now, 3 months down the road, Microsoft comes out and they say, oh, you know what? We only earned 21 cents per share. We didn't meet the analysts' expectations. So what happens? Most of the time, the price will drop because investors are disappointed. So a lot of investors are disappointed. They think that revenues may be dropping in the future, and they don't have as much confidence in the company. So they're going to sell. And the more they sell, the lower that price goes. Now, if they came out and said, hey, we actually got 25 cents per share, guess what's going to happen? Of course, the price is going to go up. There's more confidence in the market on that company. More people want that company because their revenues are increasing. So they think that there's better potential for growth in the future. So back to our ETF. ETF trades on the market just like a stock. Okay? So it is an index fund. All right? It owns Microsoft, Apple, Amazon, all of them, all the same ones, including some bonds if you want, international, whatever. It's a fund. It includes a bunch of investments. So we'll say that we're following the S&P 500 again, okay? And this is an ETF instead of an index fund. So the price of this is going to go up and down based on the performance of the S&P 500. But since it's traded like a stock, it can go up more or less than the actual index. But all these funds can go up and down like more or less than an index, because their performance is never going to truly match exactly what that index is. But it gives you an example. Anyway, I'm getting a little convoluted here. Long story short, an S&P 500 ETF is an index fund that trades like a stock. The benefit of this is liquidity, okay? These are traded in mass, like a lot of people trade these all day long, every minute that the market is open. So anytime that you want to buy, they're available. Anytime that you want to sell, they're available. The gap between the price that people are willing to buy and the price that people are willing to sell is very small, compared to, say, a mutual fund or even an index fund, that gap may be bigger because it's not traded as much. So liquidity is a major bonus to these. Another one is even smaller fees. Now you remember, anytime that you're paying fees, it's taking away from your profits. So the ETF will follow an index just like an index fund. And like the index fund had smaller fees than the mutual fund, an ETF has even smaller fees than the index fund. So if we look at, let's go over here. We'll just hit up Morningstar real fast. So we'll look at the VOO. All right, VOO is the Vanguard S&P 500 ETF. So it's just that collection of funds that tries to follow the S&P 500. If we look at fees and expenses on this, I believe it is like 0.04. Yep, 0.04%, which is very low. We can also look at other S&P 500s. So if we look at SPY, which is the Spider S&P 500, and the only difference between these is the broker or the manager. So Vanguard manages that first ETF. Now, by manager, I don't mean they literally go in there and manage it, because it's an ETF. They don't need to do a lot of managing, but they do have to do, you know, a change here or there on occasion, which is what that small fee is all about. So the Spider is a different one. It's not Vanguard that does it. It's a different company. Same thing though, they're trying to match the performance of the S&P 500. Theirs is 0.09%. So assuming that this one actually matched the S&P 500's performance and VOO also matched the S&P 500's, VOO would be a better ETF to invest in because you're paying less in expenses, or less than half of the expenses. So that's an ETF. So when you're first starting out, do you think you should buy individual stocks or ETFs? Obviously, the answer is ETFs. So you want low expense ratio ETFs, right? Because you don't want to pay your profits out to them to manage your investment. ETFs, they're just follow an index. They're easily tradable with the market. There's lots of volume, so people are trading it. It's easy to get in and out, and there's very low fees. And you get diversity. So if we look at, I actually have this. So I actually have a list of all of these stocks in the S&P 500 right now. And you can see there are over 500 stocks, hence the 500 in S&P. So the S&P 500 tracks currently 505 companies right now. And these are all of the companies that it tracks. And it just tracks the performance for all of these companies and then gives you an overall, did all those companies go up or down on average? How did they perform? So when you buy that ETF, it's trying to match that same performance. So it'll actually go in and buy all 505 of these companies. And therefore, once it owns all 505 of these companies, it's going to have the same performance as the S&P 500 is tracking. And as we know, the market has always gone up over time. And as we innovate and become more efficient as a society, businesses will become more innovative and more efficient and make more profit and grow. And that's how you make money in the market. On top of that, many of these companies will pay out part of their profits in dividends, which is just cash going to you. So Apple made however much money per share, they divide that up, and then they pay you a percentage of that. Then they keep the rest to keep growing their business. So they're giving you part of the profits. That's why I love dividends. Plus the compounding interest and reinvesting dividends, it all adds up to a major profit. Anyways, that is the S&P 500. That is how an ETF works. That is why I suggest when you first start out, here's what I would invest in. And I'm not telling you to invest in this. I'm telling you this is how I personally would start out if I was in my 20s or even 30s and didn't know about the stock market or how to invest. This is how I would do it. I would buy VOO, which is Vanguard's S&P 500 ETF, because it is low expense ratio and it follows the S&P 500. I would also buy BND. It follows the United States bond market. So it only invests in bonds, all the bonds in the United States. Now, there are some other options. If you want even more diversity, you can buy VTI, which is the total stock market index, again from Vanguard, low expense, but it gives you more diversity as it has over like 3,698 stocks or something to that effect in it. Basically, and they're United States stocks. Okay, now if you want even more diversity, you can do the VT, which is Vanguard's World Stock Market Index. Again, low expenses. Vanguard is known for having low expenses. So if you're looking at different funds from different companies, always check Vanguard's and compare it to them, because Vanguard is known to have lower expenses than the rest. Anyways, the World Stock Market Index has, oh God, I don't know how many. Total World Stock Market ETF is right here, all right? And if we look at their portfolio holdings, they have 7,975 holdings plus 75. So they have over 8,000 holdings in that one. All right. The United States one, which is the Vanguard Total Stock Market, has 3,641 right now. And VOO, as I said before, Should have about 505. Oh, it crashed on me. Yeah, 514-ish. So it depends on how much diversity you want. Now, you don't need that much diversity, but if you want to invest internationally as well as locally in the United States, then you can use VT and get the entire world's stock markets. You can also add not just BND, but you can add BNDX, which is only international bonds. So it only invests in bonds from other countries and companies from other countries. Some great portfolios just to set up, invest your money monthly and forget, never even touch it, and you're gonna do just fine, would be VU and BND. That's one portfolio. Another great one would be VT and BND, or VTI and BND. So basically any combination of these. The only thing I wouldn't do is I wouldn't buy the VU and VT and VTI, or VU and VT, or VT and VTI. I would not combine those. I would pick one from VU, VT, and VTI. Now the reason I say that is because these all own the same companies in them. So say that the top companies in the world, Microsoft, Apple, Amazon, all right, Facebook, whatever, say that they're all the biggest holdings in VOO. Well, they're also the biggest holdings in VT. They're also the biggest holdings in VTI. So if you buy all three, you're tripling how much of it you're buying. And there's no reason to do that. You're not getting diversity that way. I mean, you're still going to have tons of diversity from all of these portfolios, but you really only need one of these. So you need to decide, do I want to invest in just the United States market, and I don't need a ton of them, because the S&P 500 is the main index for the United States. The Dow and NASDAQ are there too. But I'd say most people follow the S&P 500, and that's the 500 largest companies in the United States. That's great diversity. The VT, if you want to go with the entire stock market, that covers pretty much all the stocks in the United States, and you'd be good there. Or if you want to go with the entire world stock market, then you can do that. So what happens, of course, with all that diversity is if some companies lose value and some companies gain in value, then that balances out, and that way it's not as volatile for you. I would pick one of those, and then just add either BND or BND and BNDX. I wouldn't include just BNDX by itself because it's only international bonds. You're going to want some United States bond exposure. So I would always include BND. I would have that as a staple. And by the way, if we're looking at BND, it is a Vanguard ETF, so the expense ratio is low. Expense ratio is 0.05%, very low. And BNDX, same thing, it's the Vanguard Total International one, and again it's 0.11. And if you look at most international bonds, say here's Fidelity's international bond, the fee is 0.56, which is much higher than 0.05. All right, so here is Fidelity's bond, broad market bond deal, which is an equivalent of it. Their expense ratio, hop in their prospectus real fast. Their management fee, their expense ratio is 0.36%. That's way higher than Vanguard's 0.05%. All right, so that's why I would go with BND. BND should be a staple for bonds in your portfolio. Now, when you're younger, in your 20s and your 30s, you should not have as much money in bonds. You should have the majority of your money in stocks. So you're going to go with BND and then either VU, VT, or VTI. One of those three. And if you want international exposure to bonds, then you're going to add BNDX. And that will be your portfolio. 2 or 3 ETFs. That's it. That's all you need. You don't need any more than that. That's the entire starter portfolio right there. And then when you have companies that you want to invest in, that as you learn more about investing and you know how to look at companies, whether they're good or bad, or you have total faith in this company, you just want to put a little bit of money in them, you don't want to invest a lot, then you can always add that to your portfolio. So say 2 years down the road, Starbucks drops in price to, really cheap. And you're like, man, Starbucks is doing a lot of good stuff behind the scenes. I know they're going to go back up, which again is a speculative move unless you go look at those financials and do your research, guys. But just say that you want to own Starbucks. Well, you can add Starbucks to your portfolio later and just keep it as a small position. Meanwhile, you're putting most of your money in these. So this will give you total diversification. It'll have a very small amount of fees that you won't notice at all. So here's what I do, guys. I'd open up an M1 Finance Roth, and you don't have to do M1 Finance. You can do it through Fidelity or Vanguard or whatnot. Just be aware that a lot of those guys charge fees. M1 Finance is completely free. So if you just go to my channel on YouTube, pick the latest portfolio or latest video in the description, I've got all of these links to different beginner or different portfolios of mine. And this is a beginner one that I set up. If we look at this one, and we'll see what I end up doing with this one. So this one, I have VU at 60% of my money going into the S&P 500 index. I have 20% going into the bond market. So this is all United States, the United States stock market, right? And then I added this little pie, which I have 24 companies in. These are individual stocks. Now these are all dividend paying stocks except for one, which is Amazon. And this is to start generating some income where they're paying dividends out every single quarter to you. Now all of these except for basically Amazon are what's called dividend aristocrats. What that means is all of these companies have not only paid a dividend every quarter of every year for 25 straight years, plus some of these companies have done as long as 60. Not only have they paid a dividend out every quarter for 25 plus years, they've grown that dividend every single year. So if they paid 25 cents a quarter or $1 a year, say this year, next year they will increase that by some amount. Some grow by smaller amounts, some grow by larger amounts, depending on how they're performing. But they've always increased their dividends. So instead of paying 25 cents, they may just pay 26 cents. But that's an automatic increase of income coming into you, and you've done nothing. So instead of getting $1 next year, you're going to get $1.04. So these companies are known for always paying a dividend and always increasing that dividend. And that's why they're in here. They're solid. The only reason I had Amazon is because everybody knows Amazon, and I feel it's going to be a great growth stock. It will go up in value over the years. They're just too innovative not to. But again, what you can do is you can take this portfolio I just started, hit free investing, it'll bring you here, hit build your portfolio, and then create your account and fill out all the information, and it'll automatically add this pie to your portfolio. Then what you can do is, if you don't want any of these companies, or if you don't want this pie at all, right? All you have to do is, there's going to be an edit button here. You just hit edit, and then you click a little check mark next to great start and hit remove, and it's gone. Then you have only these two, which we've already discussed, the Vanguard SP and the BND. And if you want to add different ones, then you can add those. Here, let me log into my M1. So that will be added right here. Then if you want to, all you got to do is hit edit, click next to the pies, to that great start pie that I put in there, and hit remove, and it's gone. Then you'll only have VOO and BND. And if you want to add, say that instead of VOO you wanted to do the other one, you just remove the VOO, right? And then hit add. And you can look up VT. There's the Vanguard Total World Stock Index, right? And you can add it to your basket and just add. And now the VT is in your portfolio. Or you can hit add and do VTI for the entire United States instead of the entire world, right? VT is the total world stock market. VTI is just the United States stock market. I know it doesn't make sense because VTI, you'd think I stands for international, but it does not. So you can easily come in here, add it to your portfolio, put whatever percentage you want in there. Like I said, I would suggest at least 80 in the stocks and 20 into bonds. That's how I would do it. If you're in your 20s and 30s, even your 40s. Me, I'm like 99% in the stocks right now. I'm all in because I'm starting late and I need to take more risk and get there. But as starting young, you have so much time on your hands that if the stock market has another crash or we have another big recession, you don't have to do anything except for keep contributing money to it every single month, just like you always have. Whatever you do, don't sell during those downturns. That's the biggest mistake you can make. Just hold. Just hold on to these guys. When the market recovers, you will make more money. And that's how I do it. That's how I would start my portfolio, guys. M1 Finance is easy to do it that way. You start up an IRA. I would always start with a Roth IRA if you can afford it. Your first deposit will have to be $500. And then after that, you can deposit whatever you want. But you guys really, really need to take advantage of the Roth IRA. It's only been around since like 1998. It's pretty new. And it is the best investment vehicle you can have. It's the only one where all of your dividends paid to you from these companies, all the growth that you have. So if you buy it $10 and it grows to $100 10 years, 20 years, 30 years, 40 years down the road, and then you sell it, you never pay taxes on that profit. Never. Tax-free. That's how important that Roth is. It can really help you build wealth. So open a Roth if you don't have one, guys. Open the Roth, invest your $500 off the bat, and then just monthly contributions. You need to invest monthly. The secret to growing wealth is putting money into it on a regular basis. It's not about which stocks you pick. You can just pick the S&P 500. You can just pick any of these ETFs that I just told you about. All right? This portfolio will be just fine. Just fine. And it's fully diversified. You don't have to worry about it. If there's a big downturn, if there's a recession, you don't have to worry about it. Will your portfolio show that you lost some money? Yeah, probably, but you know what? You haven't lost anything unless you sell it. And there's no reason to sell these ETFs because they're so diversified in the entire market. Everything's down. You know what that means? Everything's going to come back up. And if one or two of those companies go bankrupt, doesn't matter. It's not going to affect you because you own hundreds or thousands of companies and bonds. So you are well diversified. So there's no reason to sell when the market goes down. So this is a completely emotionless portfolio. And that's the best way to have it. So set these up, pick one, either the S&P 500, the entire world stock market, or the United States stock market. Pick one of those, throw in BND always, for all of the United States bonds. If you want to have international bonds, just for extra diversity, you can throw in international bonds as well. And that's your starter portfolio. So just those three would be your portfolio. And I'd say if you're in 20s, 30s, put at least 80% into stocks and then 20% into your bonds. If you have both of these, then you put 10 and 10, right? If you want to, or if you only want less in the international, then you can go 15 and 5. Whatever weighting you want to put. And all this is when you deposit $100, $80 will go into stocks, 15 will go into bonds, 5 will go into international bonds. That's all that means. That's your weighting, right? That's this weighting right here. Just whenever I deposit money, that's where the money's going to go, okay? And that's it. Forget it. Set it and forget it. You go over your funding, you set up an automatic deposit, which I don't have on this particular one, but we'll say this one. So you come over here, you set up an automatic deposit. I have an automatic deposit, $25 going into here every Wednesday. So every Wednesday it pulls $25 from my bank account, puts it in here, and invests into my stocks that I've picked. In your case, it'll invest in VOO and BND and possibly BNDX or VT or VTI, whichever ones you picked. And that's it. That's your entire pie. That's your entire weightings. That's it. You don't ever have to do anything. You just set up that funding and you forget about it. You don't do anything. You just know that the money's coming out of your bank every week or every month, whenever you got it set up. And that's it. You don't even have to look at it, guys. You don't even have to look at it. It's just like your 401k. How often do you look at your 401k balance? You don't. It's very rare. And it's the same thing. You're investing for the long term, so you don't need to watch it daily. You don't need to know what's going on with it all the time. You just need to constantly be contributing to it. And if you do this for the next 20 plus years, you're going to look at this account and you're going to be like, wow, this is the best decision I ever made. Especially if you put it in your Roth, or any IRA for that matter, but especially the Roth. And if you want to know more about the Roth IRA, watch my video on why you need a Roth. And I create a video titled, You Need a Roth Now. And watch that video, and I go over the Roth and tell you all the details of it and all the advantages of it and why you truly do need to invest in a Roth. And the Roth is just the account. It's just this account. It doesn't have any value. It's not an investment. It's just the account. It's just a brokerage account, just like a 401k is just an account. It's what you invest in inside of it that are your investments, which are these. So that's it, guys. I hope this helps somebody. All those new investors that are just getting started. My buddies at work who are kind of looking into it, they trust me, but they don't, you know, they want to do their own research ahead of time and understand what they're investing in, which absolutely smart. Totally agree with you. Always know what you're investing in. So I hope this explains it a little bit better about what ETFs are, why I suggest you use those, and what you would be investing in, and how to handle it, because you set it up and you forget it, just like your 401k. That's it. And you will never regret this decision. I guarantee it. 20 years down the road, you will not be regretting this decision of constantly putting money into your Roth IRA with just these selections alone. You don't need to do anything else. You don't need to learn about the stock market. You don't need to look at all these fancy portfolios of mine or anyone else's. You don't need to do any of it. You don't need to watch worry about the market going up or down. None of it. Just keep putting money into these over and over and over on a monthly basis. Invest as much as you can until you can max that Roth out every single year. So that's how I would get started, guys. Now, I'm not telling you how to invest. I'm not a financial advisor. This is my personal opinion. But if I was in my 20s, 30s, or 40s, which I am in my 40s, and I didn't want to learn how to invest in individual stocks, I didn't want the riskiness of investing in individual stocks, because the stock market is risky, but it's much more risky when you're investing in individual stocks, right? Individual companies, because those companies could perform totally different than how you think they will. Whereas with these, you are fully diversified in hundreds and thousands of different companies. So even if a few of them went bankrupt, which the chances of most companies going bankrupt, especially these, because these are all very large companies, are very slim. But even if a few of those companies did go bankrupt, it would not affect your overall portfolio much at all. So that's how you invest, guys. That's how you get started with M1 Finance or any other brokerage that you want to. Set up your IRA and add these, either just 2 or 3. All right, you've got some choices here, but I've explained them. Nice and simple. That's all you need in your portfolio. That's it. That's all you need. Done. Invest monthly. You'll be rich when you retire. That's pretty much what it comes down to. All right, guys, I hope this helps somebody. If you have any questions whatsoever, please drop me a comment down below. I will answer them. If you know me in person, always feel free to walk up to me and ask me questions on investing. I am always available for this. I love this stuff. I love the stock market. I love investing. I could talk about this all day long. So anytime that you have a question, come ask me. If you have questions and you don't know me personally, drop me a comment down below. I'll help you out. No problem at all. I'm here to help you guys. I want you guys to start investing early while you're still young, while you still have time before retirement. Don't wait until it's too late. Don't make the same mistake I did and wait until you're 48 to even start. All right? Don't do it. All right, guys. Let me know if you need anything, and I hope you're doing great. Get started. All right, guys, thanks for watching. I appreciate it. Be sure to hit that subscribe button down below, and if you liked the video, hit that like button for me.
If you want to hear any specific type of information, anything that you're interested in, you have any questions, just drop me a comment down below. Let me know what you think. Let me know your opinions on this video or any other video I've made. And if you know anyone else that might be interested in this video, please be sure to share it on your social media and share the knowledge. Thanks, guys.